Welcome to the lecture on SOD and UOP method of depreciation. SOD is sum of digits method or sum of years digits method, and UOP is units of production method of depreciation and depletion. So, in this lecture we are going to discuss about these depreciation methods and also some other methods of depreciation if time permits, and also the depletion method which is used for these financial sectors. So, first of all we will come to the sum of digits method of depreciation, and this is also known as the sum of years digits method, SOYD. So, many a times you may see the name as SOYD, or it may be something like SOD. So, how this method works? This is again also accelerated method of depreciation, where the depreciation amount is higher at the initial periods, and then they decrease as the time progresses. So, sum of digits method, it is similar to the technique of rule of 78, as we had seen. We had seen that in the case of rule of 78, basically when we have to calculate for 1 year. So, being 12 months, we calculate 12 into 13 by 2. So, that way we get 78. So, similarly here in this case rate of depreciation in for each year, it is a fraction of denominator, which is sum of digits representing years of an asset's life. So, what happens that when you try to calculate the depreciation, if suppose there are n years as the life of the asset. So, in the first year the depreciation amount or percentage will be n by sum of digits. So, it will be something like so when we talk about the SOD or SOYD method of depreciation. So, in that case that if you have n years of life, then SOYD becomes n into n plus 1 by 2. So, if you sum these from 1 to n, then it becomes SOYD, that is sum of years digits. So, that will be n into n plus 1 by 2. And in that case the depreciation which we calculate, the percentage will be, so R1 will be n by sum of years digit. So, this will be you can calculate like this. So, you will write depreciation in year 1, it will be n by SOYD into C minus S. So, if you have or P minus F, whatever you take, this is the first cost, and S will be the salvage value. So, based on that you will have these values n by SOYD into C minus S. Similarly, depreciation in year 2. So, it will be n minus 1 divided by SOYD and then into C minus S. So, this way it will go, and depreciation in year n. So, that will be basically 1 by SOYD into C minus S. So, C is the first cost of the asset, S is the salvage value of the asset, and based on that we calculate the sum of using as sum of years digit method, we calculate the depreciation charges, and we can have the examples, very simple examples, like suppose you have the first cost of the asset as 5,000, and the this S is, so C will be 5,000 rupees and S will be 2,000 rupees, and N is 5 years. So, depreciation in the first year will be so first of all we will calculate SOYD. So, SOY will be D will be 5 into 6 by 2. So, this will be 15. Now, in the first year it will be 5 by 15 into C minus S. So, that will be 5000 minus 2000. So, it will be 3000. So, it will be 1000. 3000 into 5, 15,000 by 15. So, it will be 1000. So, similarly you can calculate D2. D2 will be 4 by 15 into 3000. So, it will be 200 into 4. So, 800. D3 will be 3 by 15 into 3000. So, it will be again 600. D4 will be 2 by 15 into 3000. So, it will be 400, and D5 will be 1 by 15 into 3000. So, it will be 200. So, if you take all together, if you sum them, 10 by 18 plus 6 24 28, and this is 3000 total depreciation, it is coming as C minus S. So, this is how the depreciation amount is computed using the sum of years digit method of depreciation. Then we have another method of depreciation that is known as the units of production method of depreciation. Now, this units of production method of depreciation means many a times the depreciation of the asset will be depending upon how much you are using, how much you are producing, irrespective of the asset's life. Because if suppose you have taken a machine and it is subjected to the use, suppose it can produce suppose a lathe machine we have taken, and its capacity is that in its lifetime it can go for turning of 1 lakh pieces of the job. Now, that 1 lakh pieces can be done in a year, or even it can be done in 20 years, does not matter. So, under those circumstances, what we do is that we use this unit of production method, where the depreciation is assumed to occur on the basis of amount of work performed without regard to duration of assets life. So, assets life does not it is not that much material of importance. In fact, it will be depending upon. So, depreciation charge will be calculated based on how much it has been used. Suppose we have a trench machine which is used to trench, and its life is that it can go for maybe 1 lakh feet of the trenching work it can do. So, if so it may have a certain first cost, and now depending upon that, depending upon number of feet you have been trenching, you can calculate what will be the depreciation charge. So, suppose something in a year 25,000 feet have been trenching has been done. In that case, 1/4 of the depreciation will be there. In the second year, it may be that there is only 10,000. So, it will be further 10% only, like that. So, or if in the whole year 90,000 of the feet has been trenched, in that case 90% is depreciated. So, that way these depreciation charges are calculated, and this method is known as the unit of production method, and that is very much used depending upon the case be it. Now, we will come to the another topic, that is depletion. Now, depletion is something which is used when we talk about the depreciation of natural resources. So, when we talk about the investment in natural resources, like in the mining sector or coal sector or oil sector or so, now there a lot of investment is being done, and they are required to be recovered when the natural resources are being removed and sold. So, basically when we talk about the depreciation of the normal physical assets, then the depreciation amount which we are taking, basically that can be used for purchasing new instrument further. So, that is how you are basically given the advantage that whatever depreciation amount is calculated, you can further purchase the instrument and further do the business. Now, in the case of natural resources, what happens that you are not going to further get that mines, because once the mine is over, then things are over. So, you have to just go. So, in those cases you have a process of amortizing this cost of natural resources in accounting period is known as depletion. So, there we talk because it is depleted. So, we call this term as depletion, and there are methods by which these depletion allowances are calculated. Now, there are basically two methods of calculating the depletion charges, and the first method is the cost method, and cost method is nothing but it is similar to the units of production method of depletion. And here again we are assuming that depending upon the piecewise removal of these natural resources, whatever amount has been so suppose some mine is there, it has, or you have a timber garden, and or you have one area where you are getting the contract for cutting the timber, and you know that there is fixed amount of timber. So, depending upon how much you are cutting in a particular period, so depending upon that the depreciation charges will be calculated, and that method is known as the cost method of depreciation. And as you know that it is similar to the units of production method of depreciation, and here the depletion charge is based on the amount of resource that is consumed at the initial cost of resource. So, what we do is in these cases the depletion charge is basically calculated by multiplying the unit depletion rate with amount produced during that year. So, if you take the example of such type of the cost method of depletion, suppose you have a producer, you have a reservoir which produces basically you have estimated about it is told that it is estimated that there is 10 lakh basically 10 lakh barrels of oil is there in the reservoir. So, now in that you are putting the initial investment of 70 lakh dollars, $7 billion. Now, what we do is that as you try to take these barrels of oil from the reservoir, that there will be shortage of the oil continuously. So, based on that there will be depletion charges attributed to that. So, if you take the depletion rate, so you will take unit depletion rate. So, unit depletion rate will be basically you will have to divide this. So, 7 billion divided by 1 billion. So, you have so you get the $7 per barrel. So, $7 per barrel of oil is the depletion charge. So, if in any year if the 50,000 so if during any year 50,000 per barrel, and if 50,000 barrels of oil are produced. So, in that case so is produced. So, depletion charge if you have to take, you can simply multiply this depletion charge. So, it is per barrel it is $7. So, it will be 7 into 50,000. So, it will be $3,50,000. So, this way you will have the depletion charges that will be calculated, and it will be used, and these are used for the tax benefits as we know. So, this is the method of the cost method. So, that is known as cost method of depletion. Then another method of depletion is the percentage method of depletion. Now, what happens in the case of percentage method of depletion, what we do is we allow a fixed percentage of the gross income produced by the sale of the resources to be the depletion charge. So, in such cases whatever income you have by taking. So, these are the one where you do not have you do not know how much is the natural resource. The cost method is more applicable for those cases where you know approximately that much is the number of that much is the volume of the or amount of the natural resources, but here you do not have much idea. Now, in those cases what we do is normally a fixed percentage of gross income is normally taken as the depletion charge. Now, what happens that it may be very high. So, in those cases there is also a cap that depletion charge for any period it has not to exceed 50% of the all the taxable income of that period. So, you have total income, and then also you calculate the taxable income. Taxable income is calculated by, so if you are investing in terms of instruments or equipments, then those charges are being debited. So, you get the taxable income, and basically the depletion charge for that for any period for which we are going to calculate that should not be more than 50% of the taxable income for that period. So, this way we are calculating. So, if that becomes more than 50% of the taxable income, in those cases what we do is we take that 50% as the maximum value. We cannot take more than that. This is how this is known as the percentage method of. Now, this percentage, fixed percentage is also there. It has a particular value for the particular type of minerals. Like if you go for oil and gas wells, so this is referred from the standard book, that for oil and gas wells it is 15%, sulfur, uranium, asbestos, lead, zinc, lead and zinc 22%, gold, silver, copper it is 15%, coal, lignite, sodium chloride 10%, clay and shale that is 7.5, clay is 5, and minerals, most of the minerals like carbon dioxide produced from well and metallic ores, all these are 14%. So, these are the percentages which are to be used. Now, how to use that? So, suppose you are given that this much you are taking out, then it has you are selling it at certain rate, and then that percentage so you are that percentage will be basically calculated. So, and then it will be seen that what is the gross income, and then what is the half of that total taxable income. So, based on that only we are calculating. So, we can have an example. Suppose if you look at, so what happens that suppose the example of oil which we have seen. Now, in that if the price of oil, if price of oil is $20, so per barrel, and also expenses and other expenses are estimated as $2 lakh, other expenses are estimated to be $2 lakh. Now, what happens that you have to calculate the depletion charges. Now, the depletion charges what you do is that you get the income. So, you are getting 50,000 barrels. So, your gross depletion income. So, gross depletion income will be 50,000 barrels, and that is multiplied by 20. So, it will be 1, 2, 3, 4, 5. So, 1 million and then now on this you have the percentage. So, we know that for oil, if you look at the oil, for oil it is 15%. So, this is 15%. Now, so depletion rate is basically 15%. So, the depletion charge, so the percentage depletion charge so it is will be 1,50,000 rupees dollars. Now, we have to see that what is the total taxable income, and it should not exceed the 50% of the total taxable income. So, your gross income is 10 lakh, and the expenses which are 2 lakh. So, your total taxable income, if you look at total taxable income, it will be gross income minus the other expenses. So, it will be gross income minus other expenses. Okay. So, so that way what we will do is, you have 10 lakh minus 2 lakh. So, it will be 8 lakh, and then 50% of this taxable income will be 50% will be 4 lakh. Now, this is quite high as compared to this. So, basically you can go for this depletion charge, because this depletion percentage depletion charge should not exceed 4 lakh. Maximum of depletion charge will be 4 lakh. This is maximum value. Okay. So, that way you can go for this depletion charge, that will be the answer for such cases. So, that is how we calculate the depletion charge for using the percentage method. Apart from that, apart from these depreciation methods which we have discussed, there are other methods of depreciation also, and one of the method of depreciation is the amortization method of depreciation. Now, what we do in this case is that we are considering the time value of money, and we are basically getting. So, if the first cost is the C and salvage value is S. So, basically we are getting the present value, present worth of the S also. So, you will have C minus S into 1 plus R raised to the power minus n, if R is the interest amount, and basically we are amortizing these depreciation charges. So, that each of these annual charges what we get, they include not only to a certain extent the share of asset cost, but also the interest on the book value. So, that is how for every depreciating year you have to take that also into the account. So, in this method what we do is that your depreciating life, full life is being taken into consideration, and then we are getting these discounted scrap value. So, discounted scrap value means the S value is there. So, its present value will be S into 1 plus R raised to the power minus n. So, that will be there, and then the current value. So for that value, a annuity series type of value will be calculated, a value which will be taking into account the principal amount as well as the the discounted scrap value. So all these value is to be taken into account, and for that the annuity amount is to be calculated. So that way it is calculated, and that a basically which we get. So that will be, as we know, that if you have the current value of some so it is given as CV into R by 1 minus 1 plus R raised to the power minus n. So this is the value for the annuity when the current value of a fund is given. Now this current value will be nothing but, as you know, in this case you will have the depreciation charges if you calculate. Now in that case you will have if the C is the initial cost and S is the the salvage value. So in that case these depreciation charge which we calculate will be C minus S into 1 plus R raised to the power minus n. So that value is coming, and then this factor will be coming out, and further you will have 1 plus R raised to the power minus n. So it is nothing but it is also the P by A factor basically, if you like, or A by P factor, which we have discussed in the interest cases where we are getting this annuity value or the equal annual amount that will be there. So that is being expressed in terms of a factor. So that factor is so if you do that, if you look at this factor, so it will be 1 R by 1 minus 1 plus R minus n. It is nothing but 1 minus 1 by 1 plus R n. So basically it will be R into 1 plus R n and divided by 1 plus R n minus 1. So this is something like A by P factor or P by A factor that way. So you should do reverse, so that will be either P by A or A by P factor. So that way we calculate these dk, and once we calculate this dk, then also you have to have the fraction of the interest on depreciation, and then interest on the depreciation on the principal amount is calculated. Based on that you will have the depreciation schedule being calculated, and you will have C and S, and finally at the end of the schedule you will be getting the value of S. So this is the method, this is the method where this amortization is being carried out, and so suppose you have been given certain first cost and then depreciation, the salvage value at the end of its life, and the n is given, suppose its life is given, and in rate of interest is given, then this dk basically is calculated using this formula, and that will be basically the annual depreciation, and then the interest on depreciation. So that will be calculated basically as a percentage of, so whatever will be the interest rate, so whatever is the book value, that percentage of that book value will be used as the interest on depreciation. So the dk will be consisting of two things, interest on depreciation and interest on principal. So I mean depreciation on principal. So that way you will have two values, and based on that you have cumulative depreciation being calculated. So depreciation schedule is being found out using in this method. So we can solve a problem and get to know about such methods which are used for the depreciation calculations. Thank you very much.